What if I told you that investing just $200 a month could turn you into a millionaire without ever picking a winning stock, without touching crypto, without needing a six-figure salary, and the only real requirement is time? Let's actually run the numbers and see what happens. Meet Alex, 25 years old, fresh out of college, working a completely average job, who decides to invest $200 every single month into a simple S&P 500 index fund, which has historically averaged around 10% a year before inflation. Nothing fancy, no day trading, just showing up every month and staying consistent. By year 10, Alex has personally contributed $24,000, and the account sits around $38,000, which honestly feels underwhelming. And this is exactly the point where most people give up, because the growth looks boring and slow. A stretch investors call the valley of disappointment, where your effort feels disconnected from your results. But Alex keeps going anyway, and by year 20, total contributions reach $48,000, while the account has grown past $150,000, and by year 30, Alex has only put in $72,000 of actual savings, yet the account has ballooned to over $450,000, because somewhere in that stretch, the money Alex earned from growth started outpacing the money Alex was contributing, which is compound interest, quietly doing the heavy lifting in the background. Then comes year 40. Alex turns 65. Total money contributed across 4 full decades is just $96,000, and the account balance sits at over $1,150,000, meaning Alex turned less than $100,000 of real out-of-pocket savings into over $1 million, simply by starting early and never stopping. Now here's the twist that matters more than any of those numbers. Imagine a second person, Jordan, who does everything exactly the same monthly amount, same fund, same 10% average return, but Jordan waits just 10 extra years to start, beginning at 35 instead of 25. And by the time Jordan turns 65, the account is worth less than half of what Alex has. Not because Jordan invested less money monthly, not because Jordan made worse decisions, but purely because Jordan lost 10 years of compounding time. And those 10 years happen to be the most powerful ones. The years when the snowball is small, but rolling downhill the longest. This is the part nobody tells you when you're young, and investing feels pointless. The first 10 years won't feel like they're working. The growth will look flat. The numbers will feel small compared to your effort, and it will be tempting to stop or wait for a better time to start. But the entire game of investing for 40 years isn't about finding the perfect stock or timing the market perfectly. It's about surviving the boring years long enough to reach the exciting ones, because time in the market beats timing the market every single time. You don't need to be a genius. You don't need insider knowledge. You don't need to check your portfolio every day. You just need to start now. Stay consistent and let 4 decades of compounding do what it does best, quietly, patiently, and eventually, dramatically. The best time to start investing was yesterday. The second best time is today. And if this video just shifted how you think about your money, follow along, because next time we're breaking down exactly how to get started with your very first $100.